Well, joining me now is Jason Horn from Steyn Capital Management to share his analysis on the day's market performance. Thank you so much for your time, Jason. Let's actually start off there with the big monetary policy focus, particularly when looking at the Fed. I mean, we've heard from a number of Fed officials this week, and on Tuesday, before we went on holiday, Jerome Powell had comments for us. So what has been the overarching message here?
Well, look, I think it's pretty well documented over the last 18 months or so how high and stretched valuations in the US are. And I mean, since the tariff day back in April, we have seen this monster rally in US equities. And that has all been led by the AI play and this excessive spend we have seen in AI. And yes, to your point there, Jerome Powell alluding to the fact that equities are fairly highly valued. Probably as obvious as saying water is wet, but yes, at the same time, it's not a time of elevated financial stability risk. So we're at this point where valuations are extremely stretched in the US, and almost the market is kind of looking for further catalysts and further stimulus from the likes of the Fed and on the fiscal side. So yeah, we've got some fairly important data points today and tomorrow in terms of jobs, as well as PCE coming out tomorrow. So look, I mean, we've had the Federal Reserve kind of pivot back at Jackson Hole, saying that look, they are really looking at the labour market, and obviously we've got those labour revisions as well. And we have seen this weakening of the labour market, and now all eyes seem to be looking at inflation now, as we are starting to see a slight acceleration in inflation in the US, and some market participants are now questioning just how many rate cuts we will get going forward, and how sustainable that rate cut path is going for the next, say, 6 to 12 months.
Yeah, it really seems the Fed is between a rock and a hard place with that weaker labor market, but also inflation that is ticking up. Well, let's come back home and take a look at some of the company news that have come out of the JSE. Let's start off with Barloworld. It had an 11-month trading update that it released. The key financial metrics were lower than the prior period, but obviously, I guess, mixed numbers when you dive deeper into the different divisions. Interestingly, I saw that Mongolia, I mean, which has been the star of the show, they're showing some declines, maybe coming off a high base. What stood out for you in this voluntary update?
Yeah, 100%. I think you're right there on the lapping the high base, the order book from last year. But the reality is, the order book has fallen off a cliff, down 80% year on year. The South African side of the business looks okay, but Mongolia revenue's down 8%, and if you equate that back into rand terms, it's even worse. Ingrain's held up well, despite the difficult domestic market. But I mean, the reality is, with this potential delisting and that offer price of 120 rand, you're not seeing much share price reaction. And it does look at this stage, given the results, shareholders should be grateful for that 120 rand offer price.
Yeah, it's quite interesting that you mentioned the share price, because I was also looking at it thinking that I would see some significant movement there, but seeming that investors are looking past that and looking at the takeover. Well, let's take a look at Ethos Capital, EPE Capital Partners, known as Ethos Capital. So, of course, they released their annual results today. The investment holding company is saying that it saw double-digit growth in basically all variations of its net asset value per share. We did get that share price boost of 58%, and also the discount to NAV actually almost halving. What do you make of this company's progress?
Yeah, look, I mean, it is a company we like. It has been. This performance has been driven by their largest investment in OptAsia. So that's the white label airtime credit and lending services across 38 countries. And look, we continue to see strong growth prospects for OptAsia. So, we think that its IPO will unlock further value for EPE shareholders. And to your point, there has been the strong share price performance. That discount has narrowed somewhat. But the reality is the group is realizing assets and continuing to buy back shares, which we believe will Yeah, result in further NAV per share growth.
Okay, yeah, pretty encouraging to see that there could be further value unlock opportunities there. Before we get into the stock picks picked by your peers, Soho-san released an interesting announcement today talking about an approval for the relocation of the Caledon Casino license to Somerset West. Just flesh out the details there of this development and its significance.
Yes, absolutely. Look, the relocation has been coming for a while now. So if you think of Cape Town, Grand West has had a monopoly on casino gambling in the area for almost about 25 years. If we look to Joburg, there are 4 casinos there. So it makes a lot of sense to move the Caledon Casino to Somerset West. Think about it being a fairly underserved area.
Okay.
And yeah, the distance from Somerset West to Grand West means that there should be limited cannibalization from Sun International. But yeah, despite pressure on the casino industry from growth in online gambling, yeah, we believe that larger casinos in well-located areas should continue to stay relevant.
Yeah, and I see that that has provided a little bit of a boost to the share price today, currently up almost 2%. And we obviously know the woes that Soho-san has been experiencing, being the laggard in that hospitality and gaming space. Well, Jason, before we move on to your stock pick, let's take a moment to touch on which counters your industry peers are watching closely.
I'm feeling brave today, so I'm going with Avenge. It's still falling, so you're likely to catch a falling knife here. But I don't think it will fall to the floor. There's a lot of cash on the balance sheet still. A lot of the losses you'll see that's recently reported is from legacy contracts. If you cut off those legacy contracts, the rest of the order book is profitable, and the management has alluded to doing something about the structure. Well, they have. There's a lot of unbundling that's already happened through Avenge, and I don't see this company continuing to be listed. For over the longer term. I think they will, reach for some kind of transaction, maybe sell the Australian business and keep the local one, or wind down the local one. I don't know. Woolmans, they've got some contracts locally. I don't put too much value on that, but the offshore business, including the cash, I think is at least 3 times, conservative estimation, 3 times the value of the current market cap of Avenge.
I'm finding it in the elevator and escalator market, Zenati. So there are 4 big players in this market. I'm picking Otis tonight. It is listed in the US, so the share price is in dollars, quoted in dollars, but it makes its money around the world, and significantly in Europe and Asia, like China. Think about all those high rises they built in China. They all have elevators. Which means, because the dollar is weakening, that actually that benefits them on their reported dollar profits. And when I compare Otis to Cone, which is the Finnish business, Schindler, the Switzerland elevator business, and ThyssenKrupp, which is the big German one, these 4 dominate the industry. And there's talk that maybe Cone and ThyssenKrupp will merge, taking it to 3. Then Mitsubishi being a smaller 4th player. And that means the industry structure is very profitable when you have less players competing. And all these elevators must get serviced. So they make a lot more money from servicing elevators versus installing new ones. That has slowed down because less high rises are going up in China. But with installed base currently, a weakening dollar, a concentrated industry, I think Otis shares are looking quite attractive at the moment.
Well, Jason, pretty interesting stock picks there. I haven't heard anyone picking Avenge for a while, and I must say I'm one of the people that share price has beaten for a long time. So someone actually counting on a boost in the stock on some level, maybe even possible corporate action. Yeah, what do you make of that pick?
Yeah, look, it's not very often I agree with all the stock picks, but yeah, Avenge could be well worth over 12 Rand a share if they break it up and sell the underlying businesses. But yeah, to that point, I mean, it's not without risk. There are some problem contracts that remain uncompleted. And there are still significant contingent liabilities relating to the legacy operation. So, interesting. There is value there, but I want to tread with a bit of caution. Yes, and then on Otis, JP makes some very good points. Elevators and escalators are great businesses, and the reality is, servicing and parts is where you make your money in those businesses. And given the large installed base, this certainly is an interesting idea.
Yeah, that elevator and escalator market is actually one that has not been on my radar, so it's pretty good to know what is happening there. But in terms of Avenge, it's good to know that Dricus also gave us a warning that you may catch a falling knife, so just be careful. To your point, trade with caution. Well, let's take a look at your stock pick for today. Where are you finding opportunity?
My stock pick today is Remgro. Recently delivered a strong set of results and currently trading at about a 45% discount to the sum of the parts. They now do have a more focused portfolio. The potential of corporate action, like in many other Rupert businesses, does exist. And from our side, in our hedge funds, we have shorted some of the listed constituents as well, which also further improves our expected return on that investment. So very, very interesting one.
All right. Well, thank you so much for your time and giving us insights on what is currently moving investors' money at midday. That was Jason Horn from Steyn Capital Management.